Welcome to your monthly investor check-in. Because of the coronavirus, we're filming this update online rather than at our headquarters. This month we have Pacome from the investment team who's going to answer the questions. So Pacome, many forecasts say a recession is coming. What kind of recession?
Well, George, first we need to maybe come back to what is causing a recession. And actually, there are two major types of cause for a recession. Well, first, endogenous, caused by internal factors, or more often called cyclical recession, and exogenous, so called by external factors, typically a shocks like a war, a natural disaster, and of course, a pandemic. It's often called as well structural recession. In the case of an endogenous recession, it is often triggered by imbalance within a country due to the accumulation of contradiction or excesses, like excessive valuation in financial assets in 2000, or excessive lending and valuation in the housing sector in 2008 in the US. And it is worth noticing actually that the two most recent recessions were caused by internal factors. In short, the bubble burst. But using the definition I described earlier, in the case of the coronavirus, it looks much more like an external recession caused by the spread of the virus. And there is actually, if you think about it, some good news in this quite dark moment in the way those type of recession tend to be managed. First of all, and this is obvious to see, it is much easier for governments and central bankers to recognize it and to act accordingly and very quick in and this is what we are seeing. And secondly, it is not linked to a massive imbalance that will need to be corrected in time, which is often a slow and painful process. So overall, yes, we will have a recession. There is unfortunately relatively little doubt about it. But the good news is that those recessions are often easier to manage, especially like in the case of the virus, when the means of production are stopped but not broken. The difficulty, nevertheless, remains the uncertainty over the long-term effect of the shutdown, and it is what occupies the minds of the market at present.
Thanks, Pacome. Do you have any concerns over the size and cost of government's coronavirus stimulus measures?
There has been actually a variety of government responses. The largest immediate fiscal package coming from Germany and the US. Some of the more eye-popping measures that have been announced by other governments have come from deferral of taxes rather than real tax cuts. But the fact that they have provided support of historical proportions, along with the rapidity of action, has been very positive. Very low interest rate will be as well good for borrowers and help sustain demand when economies open up again. On the other side, the health response has been less efficient. And it took them time to recognize the issue. And probably we can think about the experience from Italy could have been scrutinized a bit further. The question is now, of course, does it create long-term risk with the creation of high deficit and debt burden, which will be difficult to reduce? We think it will likely actually increase the divergence among countries. Those that were in good shape before the crisis will be in a strong position afterward to recover relatively quickly. For those that were slowly recovering from the GFC will have difficulties. We think it is the case of Spain and Italy, which will need some help and support in the aftermath of the COVID-19 crisis.
So clearly the news is dominated by coronavirus at the moment, but are there any other economic trends that we should know about?
Well, while the COVID-19 is of course center stage, it has a lot of ramifications that will be directly or indirectly linked. Well, first of all, the price of oil. The Saudis and the Russians, through OPEC Plus, created a supply issue in a market that is impacted by both supply and demand changes. And the virus created a demand issue, and both combined resulted in a collapse of oil prices. Another key trend question concerns the durable impact on global trades and how the virus shock might change permanently what was seen almost as granted up to now. We are all aware of the impact that the US-China disputes are having on trades and the technology sector. But the fallout of this current global economic shutdown on emerging markets might become an even bigger issue. And with lower quality government infrastructure to respond to the virus and the risk of capital flight, it will be difficult for EM countries with current account deficit. Sovereign default in some emerging markets may be possible, and IMF rescue package might be necessary to be implemented by the IMF. And lastly, the Brexit issue is actually resurfacing on the news today that talks about the future relationship starting again this week. Precious time has been lost with this crisis, and will the UK still push for a December deal is another question on the table.
Thank you, Pacome, and thank you to everyone for tuning in. If you have questions for us, our CIO, James McManus, will answer your questions every Wednesday at a webcast at 11 AM. He'll also be doing the investor update at the end of this month, where he'll give you some updates on the performance of Nutmeg portfolios. Thanks for joining us. See you next time.